October 1929. The U.S. stock market collapsed, vaporizing $30 billion in a matter of days. That was more money than the U.S. government had spent on the entire First World War. Standard historical accounts often credit this to a generic wave of panic or a broken system. His name was Charles Mitchell. In March 1929, he stood before the press to publicly defy federal regulators, a decision many historians now cite as the catalyst for the final unstable leg of the bubble. Mitchell's career shows how human psychology and leverage can be combined to destabilize an entire economy. Before 1920, the stock market was a closed loop for institutional elites and old money families. Everyday Americans, teachers, mechanics, farmers, kept their money in savings accounts. As president of National City Bank, Mitchell targeted the untapped capital of the middle class. He launched a massive marketing campaign to frame stock ownership as a patriotic duty. This chart shows the mechanics of buying on margin, which Mitchell popularized. To buy $10,000 worth of stock, an investor only needed to put down $1,000 in cash. The bank loaned them the remaining $9,000. If the stock value grew by just 10%, the investor instantly doubled their money. It felt like a low-risk path to wealth. By 1929, standard margin loans were fueling the entire American economy. Total outstanding loans to brokers topped $8.5 billion, more than the physical currency circulating in the entire United States. Mitchell's margin system created a peak of perceived prosperity, even as it built the American economy on a foundation of pure debt. In March 1929, the Federal Reserve realized the danger of this growing debt. They issued a warning for banks to halt speculative lending immediately. The warning sent shockwaves through Wall Street. Margin rates spiked, and the market teetered on a collapse as investors rushed for the exits. Mitchell intervened. He stepped to the microphones to announce that National City Bank would provide $25 million in credit to keep the margin lending going, directly overriding the Fed's attempt to cool the market. The message to the public was that the big money was here to support the party. Panic turned into euphoria, and stocks rocketed to new highs over the summer. Mitchell's intervention acted like a shot of synthetic adrenaline. He kept the music playing, ensuring that when the boom finally ended, there would be no safety net for the retail public. On October 24th, Black Thursday, the selling volume was so heavy that the stock tickers fell hours behind. Investors watched their savings melt away without knowing the current price. At noon, a secret, desperate meeting was called at 23 Wall Street. Mitchell and the heads of the largest banks pooled their capital to publicly buy blue-chip stocks above market value. This was a psychological trick designed to convince retail investors that the smart money was buying the dip, which kept the retail public from selling. The recovery lasted only days. By Black Tuesday, the selling volume overwhelmed the banking syndicate's capital pool. This diagram shows the automated chain reaction caused by Mitchell's 90. He also used fake stock sales to his own wife to evade taxes. These findings led to his arrest, lawsuits, and public disgrace. Lawmakers labeled him more responsible for the crash than 50 men combined, ending his career in public humiliation. The landscape today mirrors the 1920s. Modern trading apps, meme stocks, and the normalization of extreme options leverage. You will still hear institutional leaders tell retail investors to buy the dip, while they quietly de-risk their own portfolios. When a market rally is built on borrowed money, your risk isn't determined by a company's earnings. Your risk is determined by the debt of the person standing next to you. Manage your downside risk. Ignore narratives that claim the financial system has engineered risk out of the equation. To analyze the market psychology and institutional strategies that move Wall Street today, subscribe to Streets. Markets change, but human nature does not.